For the video lecture for chapter number 6, let's do it a little bit different from previous chapter video lectures where we had gone through the PowerPoint files. So the topic of our chapter 6 is accounting for income taxes. But instead of going through the slides, let's approach it how this topic would or may appear on the CPA exam. So let me get to a blank paper here. In past accounting classes you've taken, like Accounting 201, let's see, the Business Administration 312, what you had learned was financial accounting, rules regarding GAAP, generally accepted accounting principles. Then you've probably taken Business Administration 319, where you learn tax rules, generally for individuals like you and me. Or now, in our class, 419, where we're learning tax rules for business, and specifically in this chapter for corporations, and in a future chapter for partnerships. Well, here in chapter 6, even though this is a tax class now, we are really learning financial accounting rules. And again, how income taxes appear on the financial statements, both as an expense, a deduction on the income statement, and possibly a liability. Of course, we owe the government or governments, or maybe some type of benefit we'll use in the future, like if we prepay our taxes ahead of time because the tax laws say we have to, but we don't show the expense on our financial statement until a future year. That would really show up now as an asset that we'll utilize in that future year, reducing the amount of taxes we actually have to pay, even though that future year is going to show the related expense. Now, in our Laulima site, I have on, I believe, February 5th, posted up a link right here regarding the blueprints for the CPA exam. And you can download this blueprint, if I can get it open. This link here, I think I have it already opened on my tab, specifically showing you the coverage. And here on page Financial Accounting Reporting, page 18, is our current chapter 6, the income tax coverage here. So if you take a look at the columns here, remember and understanding, you generally just have to know the principle, maybe not do any specific type of calculation. So the first subtopic here, recall the accounting treatment for uncertainty in income taxes. We always want to take a position to help the taxpayer reduce their taxes. And of course, the IRS may contest it. So there's always the probability and uncertainty that we may get audited and lose that position we've taken. So that coverage, that rule, is covered here in our textbook on page 22 of chapter 6. Okay? Accounting for uncertainty. And the key thing here is you have to know when a certain position is more likely than not to be able to be sustained in the favor of the taxpayer. And this probability has to be kind of done cumulatively. So if you take a look at this example here, example 6-18, when the more than likely, again, more than 50% is this second row here when it reaches 70%. And here's the dollar amount we can say that we can claim. Okay. Now, how you get these percentages and the probability is another question. Okay, but that's the rule. Yeah, when you exceed more than likely, in this case, more than 50%, that's the amount that we can record as the benefit. So that's the first of the four different topics listed here. The second one, recall criteria recognizing or adjusting a valuation allowance for deferred tax asset. Again, no calculation, remembering and understanding. So let me again bring up a scratch paper here. Let's start off with a clean screen. So the analogy probably would be in the case of, let's say, something you're already familiar with, accounts receivable, customers owing you money. But you know through past experience, like we learned in Accounting 201, you probably are not able to collect all that money. So what we gotta do is estimate the amount that's uncollectible using another account called the allowance for doubtful accounts, that contra asset. So here's the amount customers owe us, here's the amount that we don't expect to collect, and the amount we do expect to collect is the net realizable value or net realizable accounts receivable. Okay, so we had to set up this allowance account so we don't overstate the amount of the asset. Likewise, we're going to have a deferred tax asset. So here is the benefit we expect to gain in a future year because we probably had prepaid our taxes under tax rules. But under financial accounting rules, we don't report the tax yet. We postpone it and report the tax later on, even though we've already paid the IRS already. A typical example here would be losses or expenses that you couldn't utilize, but you're going to carry it over to a future year. Examples are net operating losses, business losses, or let's see, net capital gain, not capital gain, capital loss carryovers, or charitable deduction carryovers that you cannot utilize because of limitations we had learned in the past chapter. So all of these have to be utilized in a future year, reducing the taxes in a future year. The thing is, you gotta have a future year to carry to. And if you're out of business, well, then there's no benefit of these items. This is maybe similar to something in your auditing class called a going concern assumption. We have to be able to continue, or in the case of taxes, you have to have income to utilize to offset these deductions you're carrying over to a future year. And if there is maybe a possibility that you're not going to have income in the future years, then these assets, these benefits that are built into this deferred tax asset may not be worth as much as what you wrote down, like this accounts receivable customers owe you. So what we got to do is maybe estimate an allowance to reduce this deferred tax asset. Again, we don't sure we're going to be able to utilize all of this benefit here. So we may have to write down the asset, reducing the value. So this is part of being conservative, not to overstate your assets. And again, the rule is more likely than not. Yeah, more than a 50% chance if this has happened, you gotta increase this allowance amount. So that was the second item. The second item, let's see here. Adjusting the valuation allowance for the deferred tax asset. Now we may have a deferred tax liability, but to be conservative, you don't write down liabilities, right? You write down or reduce assets. Now, the last two items here for coverage on the CPA exam are kind of related. We're going to have to be able to calculate the income tax expense. The term used in our textbook and also in the financial accounting rules is called income tax provision. So whenever you hear the income tax provision, that's basically saying income tax expense. Okay, and now how much of this expense is currently payable to the IRS, or maybe a refund receivable from the IRS, and how much of this expense is going to be related to how much we have to pay in the future, or called deferred tax liability. Maybe you're reporting the tax now on your financial statement, but it doesn't have to be paid currently. You can postpone it to a future year, defer it, deferred tax liability. Or maybe you're reporting, maybe you're reporting the tax now on your tax return, but not reporting it as an expense or provision on the income statement. That means you paid the IRS more than this income tax expense. So now that extra you paid is an asset that's going to benefit you on the income statement in a future year, a deferred tax asset. Okay. And now you're going to be able to also journalize these entries that appear eventually on the financial statement. So again, these two are related. So let me see if I can go through an example of these two concepts here. Again, going to a blank paper. So let's talk about income statements, financial statements. We know we have the Financial Accounting Standards Board that makes statements or standards, and they all have been, well, I remember when I was an accounting student in college, it was hard. We had to learn, let's see, financial accounting standards, statement of financial accounting standards, I believe it's 109. And every year they come out with these new statements or standards. And it was a whole mess of standards, not really organized. So now, in the past few years, accounting rules have been codified. Accounting standards codification, I believe it's now 470 or 740, one of those two, regarding income taxes and how it's reported on the financial statements. So here is our financial statement, income statement, where we know we have revenue, all the ways of making money, and minusing the related costs to make that money, the expenses. And on the other hand, we have tax rules called the Internal Revenue Code. And that's what we've been learning throughout this semester. And we have income, all the different ways of making money again, minusing out the cost to make that money or deductions to arrive at the taxpayer's taxable income. And we continue by multiplying this by some type of tax rate. So under the Tax Cut and Job Act, the rate is now a flat 21%. So that kind of simplifies things. When you do your homework assignments, you'll learn smart practice questions in our Connect site. I believe make sure you use the 20% rate, the current 2018 21% rate, and not the old 34 or 35 marginal high tax rate for past years. So the answer we get here is the tax I'll call this tax bill because we owe this to the government right now for this year. Now, if I go here on the left side, what we get is our net income um, before taxes, before including in here the expense, income tax expense we have to pay to the government. So I believe our textbook calls this pre-tax book income. Book meaning financial statement. So there's differences in revenue and income here, difference between expenses and deductions here. So there's going to be differences between pre-tax and taxable income. And we learned in the past chapter to identify those differences. Some of them are just a one-time thing called permanent differences, and some are called temporary differences that will reverse their direction in future years. So what we're going to do to this pre-tax book income is to adjust it, either increase or decrease it for the permanent differences that are already reflected in the taxable income. Examples would be the municipal bond interest that's not included here but included on the revenue here. So that would be backed out on the pre-tax book income. Or maybe the entertainment expenses all deducted here under the income statement but no longer deductible at all on the income tax return. So that's added back in, right? Taken out of here by increasing the book income. So you adjust that pre-tax book income by the permanent differences to get an amount our textbook calls book equivalent taxable income. Again, here's our taxable income, yeah? But this is the book equivalent taxable income that we multiply by that same now 21% rate to get the tax provision or tax expense. So we're going to compare this tax expense that we're deducting really back up here now with the other expenses on the income statement. Compare this tax expense with the amount of taxes we're paying the government right now for this same year. And more than likely, it's not going to be the same because there are temporary differences to revenue and temporary differences to expenses. Remember, we already adjusted for permanent differences here, right? So any difference between the tax expense and payable right now are due only to temporary differences. So what we're going to do is figure out that difference, the difference between payable now and the deduction. And this is the amount, whatever dollar amount, is the deferred tax. If you owe less than this expense, then you need more deferred tax liability. Right? You owe more credit. You owe this tax right now. Credit you owe later on to this bigger tax expense here, debit. Or if this tax is bigger, you're paying more now to the government than the amount you're reporting as an expense on the income statement, then you have a deferred tax asset, debit asset, right? I'll put the arrow down here. This debit and this debit equal this credit. So let's go through a journal entry here to record debits and credits. So let's say that your tax expense reported on the income statement, debit expense is $3. But the amount you owe the IRS, we'll call that tax payable, the tax you owe for the current year, is $2. That means you still owe the IRS in a future year. Um, the word is deferred tax liability, $1. So you're balancing it off. Again, the difference here is due to temporary differences, and that they will reverse themselves in a future year. So assume nothing else happens except the same income, same expenses, but the situation reverses itself. So the next year, you're going to have a tax expense of $2. But you're going to pay the IRS taxes payable more than that too. You're going to pay them $3. And of course, to balance out, you need $1 more of debit, and you really are paying off that deferred liability you had reported, you had set up in the previous year. It's just a timing difference. Okay? So that was a situation of deferred tax liability. The most common difference that creates a deferred tax liability is taking more depreciation, accelerated depreciation on the tax return versus straight line on the income statement. Eventually, in the future year, the straight line will be bigger than the accelerated. Okay, so that is going to cause a deferred tax liability. Let's do just the opposite now. Let's have in the initial year a tax expense of $2. But you owe the government more than that. Taxes payable $3. So to equal the debits and credits, you need another debit of $2 more. And again, this is a different situation from the deferred tax liability. Here we have a deferred tax asset. We're going to pay the IRS now $3, but on your income statement you're deducting an expense of only $2. So really you're putting off this dollar expense to a future year. You're going to use that. You're not going to spend money, right? But you're still going to claim it as a deduction of future year. So that's an asset you have now. So in the future year, all things being the same revenue, same expense, but just the reversal of the deferred tax asset, your tax expense, again, your provision is $3. And on the tax return, the 101120 form, it shows you owe only $2. So that means the deferred tax asset has reversed of $1. That's this over here. So an example here where you pay more taxes in the early years and less in that earlier reporting an expense in the earlier year on the income statement is maybe you receive prepaid income. Tax laws say you got to pay taxes on it already. Accounting rules say, no, you wait till you earn the income to report the taxes. So you report less taxes now. Okay, and it reverses itself in the future year. Okay, so this is examples, simple dollar amount showing you the debits and credits. Now, probably one of the better videos to look at is one, let's see if I can pull it up here. Here in our Laulima site, in the chapter resources folder, in the chapter 6 resources folder, I have two videos linked here with this CPA review course that's on YouTube here in this channel. this Farhart accounting lectures are quite good, and he actually shows the debit credit journal entries for many of the transactions regarding income taxes. Remember, this is not our class is not a financial accounting class. It's an income tax class. But here in chapter 6, we're learning financial accounting in a true accounting firm. Probably they're going to assign the accounting department, the tax people, this specific area for financial accounting for income taxes on the income statement. So there's lots of work papers you would already have that are kind of partially showing up in our chapter 6, not the full amount. Most times what we're looking at in chapter 6, our textbook, is the principles, the concept, not really the nitty-gritty detail that you would have in a true accounting working situation. But this guy here, this Farhart, he has some good, very good accounting videos. So I have a couple linked here in our chapter 6 resource folder. So I have the first one here and second one here. And he has like a half dozen just on income taxes reported on the financial statement. Let me stop here, and in the second video what I'll do is go over the homework assignment in our McGraw-Hill Connect account. Make sure when you do your homework assignments, use the current 21% corporate tax rate and not the rate used in the video hint link. I believe it's the old rate of 34 or 35%. Also, under current tax laws, under the Tax Cut and Job Act, you no longer carry back any net operating losses. You still carry back net capital losses, but net operating losses you only can carry forward. So in the videos, you can pretty much ignore any previous year's taxable incomes because you cannot carry back any net operating losses, although you still have to account for any carry forwards. So I'll prepare some videos where maybe there is no hint video link for the homework assignment, and then maybe where there's also some clarification needed. Okay, so take a look at that second video.